Welcome to today's presentation, everyone. I'm your host, Michael Zagorski. You might say that the first half of 2022 was a pretty rough ride for a lot of investors. We saw quite a few factors come together and it sparked a lot of high inflation across much of the world and declines in many global and equity and bond markets. It took a serious toll on a lot of portfolios. For instance, the average retail investor's portfolio fell about 32% in the 3 months between March and May 2022, according to investment analysis firm Vanda Research. But among the standouts in positive territory were some commodities like crude oil. The spot price of crude oil touched the highest level in more than a decade in May 2022. It's a remarkable turnaround for crude oil, which had actually sunk to an 18-year low in the spring of 2020. The surge in oil prices in energy sent energy stocks on the S&P TSX in Canada and the S&P 500 in the United States to multi-year highs. All the while, the broader indexes were languishing. It's just one example of commodities outperforming other sectors during high inflation. It's happened in the early 1970s, for an example. Why does that happen? And what role might commodities play in a portfolio for investors seeking shelter from this high inflation? Well, we're going to dig into these questions and more in our conversation. So, joining us today are Hussein Allidina, Managing Director of Commodities at TD Asset Management, and Trevor Cummings, VP of ETF Distribution at TD Asset Management. Trevor and Hussein, thanks for taking the time to be here with us. So hopefully you guys are handling the inflation well. I know I've been riding my bicycle a lot, had to dust that off. That had been in the garage quite a while. So I don't know if you guys are doing anything personal to save on in these inflationary times, but I know I am.
It's not getting any easier out there.
Driving a little bit less for sure.
Yeah. That absolutely, yes. That's the one big thing we can do. But to kick things off, can both of you share what you each do at TD Asset Management? Maybe with you, Trevor, first today.
Yeah, so I'm one of the vice presidents of ETF distribution here at TD Asset Management. So a lot of what I do is work with investment professionals in terms of modeling and portfolio construction on how to incorporate maybe exchange traded funds into a portfolio or into a practice, as it were. These are great solutions. I've been doing ETFs or involved in ETFs since 2005, but they're not the only tool in the toolbox, right? So it's an interesting opportunity, I think, for investors to think about with their own portfolios.
Thank you. Absolutely, yes. ETFs, yeah, they've had some rapid growth as a product. Absolutely. And yourself, Hussein, what do you do at asset management?
Sure. First, thanks for having me. I joined TD Asset Management in March of 2021, and I've joined to build out commodity solutions for our clients. Prior to joining TDAM, I spent some time at a pension plan in Canada where I managed their commodity exposures, commodity derivative exposures. My background is quite deep in commodities. I've been doing commodities arguably for the last 20 odd years. I'm dating myself, but I have a fundamental background. My team and I build supply demand balances, and ultimately with the aim of trying to project and forecast where commodity prices are headed.
Okay, before we dive into our commodities conversation, I have a trivia question for our audience. The Bloomberg Commodity Index is one of the world's oldest benchmarks tracking a broad basket of commodity futures contracts. How long has the index outperformed the rate of inflation in the United States on an annualized basis? Well, stay tuned until the end of the presentation when we'll reveal the answer. So before we talk about how commodities might help protect a portfolio from high inflation, let's just get a quick refresher on inflation. First off, can you describe the way inflation might impact a portfolio's performance, Trevor?
Yeah, sure thing. I guess loosely defined, inflation is the rising price of goods and services. The most commonly referenced measure of that increase is the CPI, or the Consumer Price Index. And that's a phrase that we would use both in Canada and the United States. Now, CPI compares a current and past price basket, sort of a sample market basket of goods from a variety of categories, including housing, food, transportation, apparel, and so on. So, central banks in both the United States and Canada generally expect to see inflation rise by 1 to say 3% per year. It's when prices climb too quickly that inflation can become a problem. So when we as investors are investing for our own long-term goals, it's important to consider the effects of inflation on your returns. Over time, inflation can erode the value of an investment and therefore, our purchasing power. For example, if a portfolio provided, say, a 3% return, but inflation is 4%, then it's actually down 1% in real terms because that portfolio won't buy as much in the future.
For more information on the impact of inflation on a portfolio, you can watch our webinar, How I'm Managing My Portfolio During High Inflation, with our guest Mark Seed, and that'll be found within the learning section of WebBroker. All right, so let's talk about commodities and how they might be able to protect your portfolio during high inflation. So, Hussein, I'm going to start with you for some background on this asset class. So, what is a commodity, and what are some examples that might be familiar to most investors?
So a commodity is a basic good. Think about things like oil, corn, copper. Commodities are fairly uniform. In practice, a bushel of corn in Iowa, that corn is going to be pretty similar or homogeneous to the bushel of corn that's produced in southwestern Ontario or that's produced in South Africa. Now there are differences. There's minor differences, but broadly speaking, they're very similar, and that's what allows you to then, have a standardized contract on the New York Mercantile Exchange or the Chicago Board of Trade where you can trade these underlying commodities. We trade, or when you invest in commodities, typically you're not investing in the physical commodity because more than likely you don't have the infrastructure to store and transport the bushel of corn or the barrel of oil, but you can still take exposure or garner exposure to these markets via the commodity derivatives, which are, exchange contracts that give you the right to either take ownership or deliver the underlying commodity at a certain price in the future.
Perfect. Thank you. Excellent. Hopefully that clarifies for the audience some. So commodities, yes, they're typically more volatile in price and potentially riskier to hold than equities or bonds. So what can make commodities so volatile?
It's true that they are more volatile than fixed income for sure, and in most cases more volatile than equities. One of the reasons why commodities are more volatile has to do with liquidity. Liquidity in commodity markets, though good, is not as broad or as deep as the liquidity, for instance, that you would find in the FX market or in the fixed income market. Other reasons why commodities are more volatile, supply and demand plays a big role in that. There is a lag between when a price changes and it has an impact on either the supply side or the demand side. So that lends to volatility. Think about what happened, for example, during the pandemic. We had a material fall in demand, and that material fall in demand was not met in the same time frame with a similar contraction in supply. So that brought about a tremendous amount of volatility. Ultimately, that oversupply contributed to sending prices to record lows. You recall crude traded negative, or WTI traded negative for a brief period of time around the pandemic. So those changes in supply and demand, and frankly the lag time between when a price changes and you see a change in the supply or demand response lends to volatility. Another thing to keep in mind in commodities, leverage. Commodity futures typically have a very low level of initial margin. So, if you're trading crude or corn or, some of the other commodities that I've mentioned, you really only need margin of somewhere between 5 and 15%, which again contributes to increased volatility in periods where the underlying commodity is moving. And the final sort of difference may be why commodities are more volatile. Geopolitics and the environment have a very acute impact on commodities. Geopolitics impact equities, they impact fixed income, but when you have a supply side disruption in Libya, for example, the impact on the oil balance is going to be far more pronounced than it is on other markets. And similarly, the environment. Commodities are, very susceptible and influenced both on the supply and demand side by the environment. Weather plays a material role. For example, weather plays an important role on ultimately how much corn and or beans will be harvested. So that presents additional volatility to the commodity space that maybe is not as relevant for other asset classes.
Now, investors might be familiar with the spot price of a commodity, what it is trading for today, but really what's important is also what a commodity is expected to trade for in the future. That's a key factor to consider. Can you walk us through the two pricing dynamics that can influence commodity markets?
Yeah, for sure. And this is I think a very important part of this discussion. A commodity return, or the return that an investor receives for investing in commodities, is not just the change in the spot price. You have to think about the shape of the forward curve. And when you're talking about commodities, you might hear terms like contango and backwardation. And I want to take a minute and explain what those terms mean, because again, they are quite important in the total return that you receive for investing in commodities. So, the shape of the forward curve, if it's upward sloping, it's a curve that is referred to as a curve being in contango, which means the price today is lower than the price in the future. And if you think about, we go back to the example of, the farmer. The farmer has to be compensated to store that corn in their silo. So there is a storage cost, an insurance cost, and the cost of money. So for him to be able, or for her to be able to do that, the curve has to leave them indifferent between selling it today or holding it and selling it in the future. So the price in the future has to be higher. A curve that is downward sloping or in backwardation is a curve where the price of the commodity today is higher than the price tomorrow. Now, broadly speaking, the shape of the curve is going to be a symptom or a function of the underlying level of inventories. In markets that are tight, consumers will apply or be willing to pay a scarcity premium to have that commodity today relative to waiting until tomorrow. If we look at the crude oil curve right now, it's in backwardation because crude oil inventories are quite tight. Other commodities like corn, for example, which are tight but not as tight, are trading in contango, again, to incentivize or to leave the farmer indifferent between selling her corn today and holding it into the future. I hope that makes sense.
To build on that, picture your idyllic farm, old McDonald's farm. There's bingo in the corner if you look closely. Think of, say, livestock, for example, right? If I have to feed that animal for 6 more months, then I'm going to add that to the cost of future delivery. Now, in contrast, if inventories are very tight, or there's some shock, or they fall because of war or drought, perhaps, which lowers supply temporarily, then prices today move to a premium, almost as a self-correcting mechanism to encourage some consumers to defer demand. So think of livestock, 20 pigs, on this farm under a balanced market, each pig is, $2 a pound or something like that. So contango means the demand is stable, the supply is reasonable. If you want to buy them a year from now, you've got to pay Farmer McDonald more than if you wanted to take delivery today. Backwardation is if there's a scarcity of pigs, there's such demand to buy them today, some immediacy maybe, and so the farmer is going to be able to charge a premium for those pigs today. Whereas if you're willing to wait, it's not quite a discount, but think of it conceptually as if you're willing to wait, you can get a better price, down the road. So by understanding really the supply and demand dynamics on pricing of a commodity, an investor is really better able to understand the cause of those price movements.
Okay, so let's take a pause for a moment. Some of our audience might be wondering where they can find info about market dynamics of various commodities. Well, web broker is a great place to start. First, what we want to do is go under a web broker, research, and then under the heading markets, we want to click overview. So from here, we're going to scroll down all the way to the commodities section. And from here, we can see that there's the energy, the metals, and the agriculture tabs for some of the more common commodities out there. And from here, you can basically see how the current prices of various commodities are tracking against historical levels. The next thing we'll do, we'll scroll back to the top of the page and what we're going to do is click on the news tab. So from here, we can basically filter for some commodity news. So what we want to do though is filter first. So what we're going to do is click on categories. From here, we're going to uncheck all news and instead we're going to click on commodities instead. And then from here, you can choose to look at energy, metals, agriculture, whatever you want to look at. And you can also customize how far back you're looking. So let's say we check off today. We click View News in the lower center of the page. And now we can see that there's 9 stories today that involved commodities. So this is another way you could do some further research. Last thing we'll do though is click on reports. So from here, you can look at the reports on energy and materials just for some more analysis on those market dynamics. What you want to do is scroll down a little further. On the right side is the Morning Star Research Sector Reports. So from here, you can click on the materials and on the energy reports just to get a little more information on what's going on, what developments are occurring in the commodities sector. All right, hopefully that demo was helpful if you're interested in researching further. Now, we sometimes hear that holding commodities may be one way to diversify a portfolio, particularly during times of high inflation. Why is that?
If we look back historically, if we go back to the 70s as an example, the last period when we had inflation prints that we're seeing, in 2022, that inflation was caused by, frankly, the price of commodities moving higher. And in that case, it was primarily crude oil prices and energy prices broadly that moved higher. That crude oil price inflation fed into, pardon me, general sort of CPI. So to answer the question just very bluntly, typically the reason why commodities serve to be a good hedge to inflation is because they are the cause of inflation. Higher energy prices also will feed into service inflation, and that is something that we're seeing today.
Maybe I'll just add there, Michael. Historically, the performance of commodities has had a low or negative correlation to the performance of other asset classes like stocks and bonds. Correlation means the movement of different asset classes in tandem. And it's a number that ranges from -1 to +1. It's a mathematical or statistical measure. The higher or the closer to 1 that number is, the more two things would move in lockstep with one another. And the closer to -1, the more opposite they would actually move against one another. So as you build a portfolio, you typically want to have some element or some portion of your accounts that have a low or even a negative correlation so that you're diversifying your risk sources. So if we think about, say, some S&P Dow Jones research, they found that commodities represented by the S&P Goldman Sachs Commodities Index had a correlation of -0.02 with global equities and -0.08 with fixed income from December 1972 to June 2012. So, equities and fixed income are anticipatory assets, right? Their value is based at least in part on what they're expected to be worth in the future. So their price is likely affected by changes in the economic or the business environment, for example. An interest rate hike, there's a few of those these days, that might affect the ability of a company to produce earnings in the future. And that's why maybe that impacts the price that investors are willing to pay for that business, for that price of stock. Now, on the other hand, commodities are really, again, largely driven by supply and demand. So, the raw materials required to make many of these products may be less sensitive to changes in some short-term economic or business conditions. So an interest rate hike might not affect the demand or supply of, say, crude oil, certainly in the short term.
So, how have different types of commodities performed during previous instances of high inflation, Hussein?
Within the sort of commodities that we consume, it is historically energy that has provided the best hedge to inflation. And we discussed earlier, partially because it is the source of inflation. But it is those commodities that ultimately drive GDP. And, you know, as you see, robust growth and any sort of supply constraints on the commodity side, you see resulting inflation. So to hedge that inflation, if you own the asset that's causing the inflation, you tend to be well served. Gold is different, and gold tends to do a better job in the tails of inflation. So if you're getting inflation because we're worried about currency devaluation or material risk off sentiment, gold tends to be a better store of value and an alternative, frankly, to fiat currency. So I believe that commodities and gold both serve a role in portfolio construction or serve a role in your portfolio, but I do believe that they have different betas or respond differently to different types of inflation. The type of inflation that we're seeing today, which is driven by supply side challenges, I think you do better in something like energy. If we were to get inflation that was driven by fiat currency devaluation, like we saw around the depegging of gold and the dollar around Bretton Woods, then gold tends to perform better. I hope that makes sense.
What are some factors an investor might consider to help them decide how much to allocate to commodities during periods of high inflation?
I'm going to say it's a tough question. It's a tough one to sort of nail down. There's no universal answer, I think, is the short version, and maybe I'll give you the longer version. There's a couple different factors I think that investors need to consider to help them determine the asset allocation that might be right for them, including their comfort with risk and reward, their time horizon, of course, their investing goals. That's obviously going to be pretty important. A higher exposure to commodities might offer a higher expected return during periods of higher inflation, but that might carry more risk or more volatility that some investors just might not be comfortable with. For example, it is possible, certainly, that the higher expected risks might outweigh the benefits of higher expected returns in certain circumstances or to certain investors. We're all different. That said, investors may benefit from diversification into an asset class with lower correlation to stocks and bonds, as we discussed. So during periods of higher inflation, some investors might consider increasing commodity exposure given the historic outperformance of certain commodities during those sort of environments in hopes of offsetting some of the impact of inflation. It is, of course, I think it behooves us to remind everyone that we got to really understand and appreciate that past performance certainly doesn't guarantee future results. So, a lot of this data is backward looking. And so we'd say, as investors, we all need to consider our own tolerance for risk before making those asset allocation decisions.
Yeah, maybe I can add just a piece to that, Trevor. If you look at portfolio construction, portfolio theory, there's a ton of academic work that's been done on sort of creating the optimal portfolio. And historically, the balanced portfolio was 60/40 that a lot of folks are comfortable with. If you take a traditional 60/40 portfolio, the addition of commodities, because of the low correlation that you mentioned, has the effect of pushing out or improving the efficient frontier. And I'll define that, right? The efficient frontier is the amount of return that you get for a given level of risk. The analysis, again, historically shows that an allocation to commodities in a portfolio of equity and fixed income improves the amount of return you're getting for a given level of risk. And that has primarily to do with the low correlation of the asset class to equities and fixed income.
Now, so what are some options an investor might have to gain exposure to commodity markets during periods of high inflation?
Yeah, I mean, there's a plethora, of different options, I guess, that investors could think about to gain exposure to commodities. There are physical commodities first, that you can go out and purchase, such as gold wafers or bars, and you can keep it in safekeeping. So you get a set amount of exposure to, maybe a precious metal commodity. There's commodity futures contracts, which we discussed earlier, right? So the backwardation or the contango. That gives you control of the underlying commodity at a set point in the future at an agreed upon price. The intention of traders usually is to close or roll forward those contracts into the future rather than to sort of take physical delivery of the commodity. You can buy stocks. You can think about stocks in commodity related businesses. That's another avenue. Just be aware that the price of the underlying commodity is one of many factors that would impact the price of that stock or that business, right? For a commodity related business. So, an oil and gas company, yeah, oil is a pretty important indicator of the future success of that business. But there's also management, leadership, strategy, financials, all sorts of other things as well. There are commodity exchange traded notes, or ETNs, exchange traded notes, that are debt instruments issued by the company in question that aim to match or deliver the returns of an underlying commodity. So those ETNs, they mature because they are notes, and they promise to deliver the return of the index that they track in cash minus any fees. Be aware that the repayment of principal invested depends in part on the performance of the index. And so that index goes down or doesn't go up enough to cover the fees, you could receive a lower amount at maturity than what was originally invested. And then maybe closest to home for me is simply commodity ETFs or mutual funds, commodity exchange traded funds or commodity mutual funds. They're invested typically in a basket of physical commodities and or commodity derivatives. So you can get some diversification that way as well.
Thank you, Trevor. Yes, it does look like there is, quite a few various investments that could fit the commodity portion of a portfolio. So I did want to then just take another pause. We're going to dive into WebBroker because it does look like there's a fair amount of research an investor might want to do to make sure they find sort of what's right for them. So this time, I just want to show you our audience just a tool that may help you weigh the risks and rewards of commodity investments. Okay, this time we're going to look at some of the risk return analysis charts within the ETF section. So from here in WebBroker, we're going to click on Research. This time we're going to click ETFs. And from here, we're just looking to look into more specific commodity ETFs just to see sort of some of the risk versus return characteristics of some of the funds. So from here, I do have it selected already under the US, but you could have Canada instead. There's two different tabs here that you can click on. What we're going to now do is click Categories. And from here, we can then go a little deeper. We have several different categories like equity energy, commodities broad basket, commodities focused. So these are various categories you might look into to see various funds and then compare them. As an example, right now we're just going to click under the equity energy category. And then from here, I'm going to scroll down. You can click select all, but you may find that it's a pretty busy chart with up to 25 data points, which might be a little much to analyze at once. But let's, for example, choose 4 different funds just randomly today, just as an example. And what I'm going to do is leave highlight as none. Under size represents, I'm going to go year to date in this example, and I'm going to click go. Now here's a chart showing you the risk versus reward. So what we have on the bottom, the horizontal axis, is the rate of return or performance down on the horizontal axis. And then on the vertical axis, we do see the risk. So the level of risk and volatility is on the vertical axis. So we'll notice some of the funds that have done better are highlighted in green, whereas the funds that would have performed poorly are highlighted in red. So they are color coordinated for you. So this is just another way where you might look at at the performance of various funds and sort of compare what their return to risk has been and maybe find something that you're looking for that works for you. So, but remember that the analysis shown here is historical and past performance does not guarantee future returns. All right, hopefully that demo gave viewers another tool to consider when investing in commodities. So thanks for walking us through the ins and outs of investing in commodities, Trevor and Hussein. So we're going to move over to our live audience Q&A shortly, but first let's reveal the answer to our trivia question. As a refresher, the question was, the Bloomberg Commodity Index is one of the world's oldest benchmarks tracking a broad basket of commodity futures contracts. Since which year has the index outperformed the rate of inflation in the United States on an annualized basis? And the answer is 1960, if you can believe it. During that time, the basket of commodities has averaged a return of about 3.9% annually. US inflation has averaged about 1.85% annually during that same time. Of course, it's important to remember that the historical performance is not an indication of future performance, but still the trend observed over the past several decades is compelling. Okay, Hussein and Trevor, let's head over to our live Q&A and hear what's on the mind of our audience members.